Did you know the average American retires with only $266,345 in savings? That might seem like a decent sum, but with rising living costs, it hardly screams financial freedom. But what if I told you there's a little-known strategy that can help you dramatically increase your retirement nest egg? A strategy so powerful, it can turn a seemingly insignificant $10,000 into a life-changing $163,841. Yes, in this video, we are talking about the Rule of 72. Most financial advisors don't want you to know about the Rule of 72. Why? Because if you unlock this secret, you might no longer need their expensive fees. So let's jump right into it. The Rule of 72 is derived from a simple calculation that reveals how long it takes for investments to double. However, like any potent tool, it has caveats. Understanding these details empowers you to use its full potential as your financial compass on the path to prosperity. Number 1. The Rule of 72. The Rule of 72 is a powerful mathematical tool in finance. This formula goes beyond mere utility. It serves as a guide for making investments, managing economic fluctuations, and planning long-term finances. Imagine the Rule of 72 as your financial oracle that reveals the secrets of investment growth under a fixed interest rate. Its elegance lies in simplicity. Divide 72 by the expected rate of return. For example, with a 5% interest target, dividing 72 by 5 results in 14.4. This indicates the years needed for your investments to double. The appeal of this rule goes beyond its fundamental use. It not only outlines the timeline for doubling investments, but also acts as a quick test, helping you align with economic trends and make informed financial decisions. However, like any tool, the Rule of 72 has caveats. It excels with assets employing compound interest annually, facing accuracy challenges below 6% or exceeding 10%. Despite these limitations, see them as signposts on your financial journey rather than obstacles. Utilizing the Rule of 72 to its fullest involves consulting with an experienced financial advisor. Their expertise provides detailed insights into your investment strategy and long-term financial goals. The Rule of 72 acts as your financial guide that offers indispensable guidance through the labyrinth of investments and economic forecasts. Understanding its strengths and limitations empowers you to achieve wealth and financial stability. As you apply the Rule of 72, it becomes a powerful tool in your financial toolkit, adapting to the evolving landscapes of your investments. Its versatility enables you to assess doubling timelines across various interest rates, as it helps you to have a deeper understanding of your financial path. However, it's crucial to acknowledge the rule's sensitivity, especially when dealing with interest rates outside its optimal range. Its simplicity doesn't diminish its significance. Rather, it amplifies accessibility and makes it a valuable resource for both seasoned investors and those new to the financial arena. Number 2. Compound interest. Diving further into financial wisdom, let's explore compound interest, a powerful force driving long-term financial growth. It's the key that unlocks prosperity for those with patience and strategic planning. Compound interest turns your invested capital into a perpetual generator of wealth. It's not just about earning interest on the initial amount. It's about earning interest on the principal plus the accrued interest. This creates a cycle where your money actively participates in its own growth, a financial snowball effect propelling your earnings.
The biggest thing in making money is time, and I've had this long run. And so the compounding at the end turns into very big numbers.
Understanding compound interest is like discovering secrets to building wealth. Its significance is crucial. Exploring the Rule of 72, envision an interest rate of 6%. Applying this, it takes 12 years for your money to double. The true potency of compound interest lies not only in comprehension, but in strategically leveraging it to your advantage. The length of time your money remains invested significantly influences the power of compound interest. The more extended your investment duration, the more significant and impactful your earnings. It's a journey where time supports you and strategic patience guides the way. Consider a practical example. Imagine investing a sum with a modest 6% interest rate. Initially, the growth may seem gradual, but as compound interest gains momentum, your earnings start compounding. Each interest calculation becomes a building block, contributing to the exponential growth of your wealth. Think about seeking investments with higher interest rates. It's like planting seeds in fertile soil. Opting for higher interest rate investments nurtures your financial seeds with optimal conditions, ensuring a more bountiful harvest in the future. This proactive investment approach aligns with the core principle of compound interest, where higher rates amplify the growth potential of your wealth. Number 3. Investments. Investments, like seeds, promise prosperous financial futures when planted wisely. The Rule of 72 acts as a reliable guide, illuminating the temporal dynamics of doubling your money. Whether in stocks, government bonds, mutual funds, or savings deposits, the Rule of 72 serves as a practical advisor, offering insights into future returns. Let's explore scenarios to grasp its application. Savings deposit at a 1% annual rate. Applying the Rule of 72 reveals a lengthy timeline, suggesting your investment would double in approximately 72 years. This emphasizes slow growth tied to lower interest rates, urging exploration of alternatives for more robust returns. Government bonds at a 5% annual rate. Using the same rule, your investment is projected to double in about 14.4 years, indicating a faster growth trajectory. Government bonds become an attractive option for those seeking a balance between security and growth. Mutual funds at an 8% annual rate. The Rule of 72 suggests your investment in mutual funds could double in roughly 9 years, showcasing accelerated growth potential compared to safer alternatives. Stocks with a 12% annual return. For stocks, the Rule of 72 predicts a doubling of your investment in approximately 6 years, highlighting dynamic and quicker growth potential inherent in the stock market, albeit with higher associated risks. Number 4. Inflation rate. Understanding inflation resembles gauging an economy's pulse, a crucial skill in navigating the dynamic financial landscape. The inflation rate acts as an indicator, revealing the pace of price escalation over time. As inflation rises, the purchasing power of money decreases, impacting the costs of everyday goods and services. The Rule of 72 is a valuable financial tool for planning against inflation's effects. For example, with a steady 3% annual inflation, the Rule of 72 shows prices doubling in around 24 years. If the inflation rate spikes to 6.8%, prices will double in a mere 10.6 years. This insight serves as a strategic financial planning tool. By using the Rule of 72, individuals can anticipate inflation's impact and devise effective strategies to outpace its erosive effects. It's about staying ahead and ensuring your savings and investments remain resilient against inflationary pressures. Using this rule empowers you to forecast price trajectories and adapt financial strategies accordingly. It encourages a proactive approach to financial planning, allowing you to protect assets against the rising tide of inflation. Furthermore, the Rule of 72 acts as a wake-up call, urging individuals to take proactive measures. Whether investing in assets with potential or creating comprehensive long-term financial plans to mitigate inflation's effects, understand the Rule of 72 as more than just a formula, but as a helpful tool in your journey towards financial security. It goes beyond numbers, helping you manage fluctuations in prices due to inflation. The Rule of 72 extends beyond investments and inflation, integrating with broader financial considerations. It acts as a bridge between your current financial standing and future aspirations, providing a roadmap through economic complexities. Number 5. Savings. The Rule of 72 plays a central role in projecting savings growth, offering a powerful tool to estimate when financial reserves might double. It serves as a guide towards a more secure financial future. Considering options for safeguarding savings, some may consider keeping cash at home, posing risks of loss, theft, or devaluation due to inflation. Others may explore the stock market's potential for substantial growth with inherent risks. Some opt for savings accounts with banks for perceived safety despite minimal interest rates. Utilizing the Rule of 72 helps project the doubling time for savings based on the interest rate. For instance, with a 1% interest rate on a $1,000 savings account, the Rule of 72 indicates it would take about 72 years to double, quite a lengthy time frame. However, financial markets offering 4% to 7% interest rates annually make the Rule of 72 a potent tool, significantly reducing the doubling time. Imagine a scenario with a 5% interest rate. According to the Rule of 72, savings would double in about 14.5 years, highlighting the importance of informed decisions on where to keep savings. Exploring investment programs with better interest rates can significantly expedite savings growth. Number 6. Retirement planning. The Rule of 72 proves to be a valuable tool when it comes to crafting a robust retirement plan. As individuals navigate the maze of financial decisions leading up to retirement, understanding how long it takes for their savings to double becomes crucial. Imagine you're diligently contributing to your retirement fund, aiming to accumulate a substantial nest egg for your golden years. The Rule of 72 can offer profound insights into the growth trajectory of your retirement savings. For instance, let's consider a scenario where you have an expected annual return rate of 8% on your retirement investments. Applying the Rule of 72, you can quickly calculate that your retirement savings will double in approximately 9 years. This knowledge empowers you to make informed decisions about when to retire and how much you need to save to achieve your desired lifestyle in retirement. The Rule of 72 serves as a guiding light, allowing you to assess the impact of different rates of return on your retirement savings. It prompts thoughtful consideration of investment choices and risk tolerance, aligning them with your retirement goals. By utilizing this rule, you can project the growth of your retirement savings over time and make adjustments to your strategy as needed. Furthermore, the Rule of 72 encourages individuals to start planning for retirement early. The earlier you begin saving and investing, the more time your money has to benefit from compounding, leading to accelerated growth. This early planning can be a game changer, potentially allowing you to retire earlier or enjoy a more comfortable retirement. As you deal with the complexities of retirement planning, the Rule of 72 acts as a compass, providing a clear direction. It's not just about accumulating a certain amount of money. It's about understanding the dynamics of your investments and making informed decisions that align with your retirement vision. Additionally, the Rule of 72 facilitates realistic goal setting for retirement. Knowing how long it takes for your savings to double allows you to set achievable milestones along the way. Whether you aim to have a certain amount saved by a specific age or plan for a gradual transition into retirement, this rule equips you with the insights needed to structure your retirement goals effectively. Moreover, the Rule of 72 encourages a proactive approach to retirement planning. Instead of relying solely on guesswork or generic retirement calculators, individuals can actively engage with this rule to tailor their plans to their unique financial situation. By considering factors like expected rates of return and adjusting for potential economic trends, you can refine your retirement strategy to adapt to changing circumstances. Number 7. Debt repayment strategy. While the Rule of 72 is commonly associated with investments and savings, its application extends to devising an effective strategy for managing and repaying debt. Understanding the rule's implications can be a game changer for individuals aiming to achieve financial freedom by breaking free from the shackles of debt. Consider a scenario where you have outstanding debt with an annual interest rate of 10%. Applying the Rule of 72, you can swiftly calculate that your debt will approximately double in 7.2 years. This realization serves as a wake-up call, emphasizing the urgency of addressing and eliminating high-interest debt. The Rule of 72 acts as a financial compass, guiding you in evaluating different debt repayment scenarios. It allows you to compare the doubling time of your debt at varying interest rates, aiding in prioritizing which debts to tackle first. By strategically addressing high-interest debts with shorter doubling times, you can expedite your journey to debt-free living. Moreover, the rule provides a tangible timeline for setting achievable debt repayment goals. Instead of feeling overwhelmed by the abstract concept of debt reduction, you can use the Rule of 72 to establish realistic milestones. For instance, aiming to halve your outstanding debt in a specific time frame becomes a concrete and measurable objective. As you navigate the terrain of debt repayment, the Rule of 72 encourages a proactive approach to managing your financial obligations. It prompts individuals to explore options such as debt consolidation or renegotiating interest rates to optimize their debt repayment strategy. By actively engaging with this rule, you gain a clearer understanding of the impact of interest rates on your debt and can make informed decisions to minimize the financial burden. Furthermore, the Rule of 72 underscores the importance of avoiding high-interest debt whenever possible. Armed with the knowledge of how quickly debt can accumulate, individuals are encouraged to make prudent financial choices. Steering clear of borrowing at exorbitant interest rates, this proactive mindset aligns with the broader goal of achieving and maintaining financial well-being. So the Rule of 72 transforms into a tool for financial liberation when applied to debt management. It provides a structured framework for individuals to analyze, strategize, and execute a plan to overcome debt. By acknowledging the doubling time of debt, you gain a newfound perspective on the urgency of repaying high-interest obligations and can tailor your approach to achieve tangible results. Number 8. Real estate wealth building. The Rule of 72 proves to be an insightful tool when venturing into the realm of real estate investment. Whether you're considering buying property for rental income or long-term appreciation, understanding the doubling time of your real estate investment can enhance your decision-making process.
They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation. That's one reason real estate in general is good during.
Imagine you're contemplating an investment in residential real estate with an anticipated annual appreciation rate of 6%. Applying the Rule of 72, you quickly calculate that the value of your property is projected to double in approximately 12 years. This knowledge becomes instrumental in formulating a comprehensive strategy for wealth building through real estate. The Rule of 72 acts as a predictive guide, allowing you to forecast the potential growth of your real estate assets. It aids in comparing different investment opportunities by assessing the doubling time in varying appreciation rates. This comparative analysis empowers you to make informed choices about where to allocate your real estate investment capital. Moreover, the rule serves as a risk assessment tool. By understanding how long it takes for the value of your real estate to double, you can gauge the stability and potential returns of different property types and locations. This insight is invaluable when diversifying your real estate portfolio or deciding whether to pursue residential, commercial, or rental properties. The Rule of 72 prompts you to consider the long-term implications of your choices. It encourages strategic thinking about when to buy, sell, or reinvest in properties based on your financial goals. Whether you're aiming for consistent rental income or capitalizing on property appreciation, this rule guides your decision-making with a clear understanding of the timeframes involved. Furthermore, the Rule of 72 encourages a disciplined approach to real estate investment. By acknowledging the doubling time of your property's value, you can set realistic expectations and timelines for your investment objectives. This disciplined mindset helps you avoid impulsive decisions and aligns your real estate strategy with your broader financial plan. So thanks for watching this video. If you enjoyed watching it, please consider giving it a thumbs up and subscribe for more content.